I'm George Ratiu, Manager of Economic Research with Realtor.com. Temperatures are rising across much of the country, covering large swaths under a blanket of heat. Many people are looking for a reprieve by going on vacation, seeking the breeze of an ocean or the freshness of mountain air. Market signs are sketching an economy where consumers are traveling and spending more, but growing more concerned about the jobs outlook, while companies are cautiously watching for slowing demand with an eye toward cutting expenses. This week, initial and continuing jobless claims inched up as some of those companies moved to contain costs. The numbers remain at pre-pandemic levels and the job market is still solid. However, continued increases in layoffs could signal a bigger change for the economy. Real estate markets feel the heat of high inflation and rising interest rates. Mortgage rates increased again this week as capital markets are flashing brighter signs of an impending recession. We saw the spread between the 2-year and 10-year treasuries moving even deeper into negative territory this week, referred to as a yield curve inversion. Why is that relevant? Because yield curve inversions have preceded most economic recessions of the past half-century. All eyes are on next week's meeting of the Federal Reserve. Mortgage applications dropped to the lowest level since 2000 as buyers are finding that high prices and rising rates have sliced their purchasing power considerably. Not surprisingly, sales of existing homes dropped for the 5th straight month in June, hitting the lowest level since June 2020 during the COVID lockdowns. While inventory picked up, prices continued rising to a new record. Meanwhile, on the new construction side, the landscape is getting cloudy. The NAHB Home Builder Sentiment Index fell for the 7th consecutive month, posting the second largest drop on record. Construction companies are worried about declining sales, buyers pulling back, and a slumping outlook. In turn, new construction is slowing, with housing permits and starts taking a step back in June as builders pulled back on single-family homes. Construction of multi-family projects picked up during the month, however, a signal that builders see the rental market on relatively better footing. Yet for many Americans, the affordability squeeze is also felt in the rental market. Realtor.com's latest report found that while it is less expensive to rent than buy in 38 of the 50 largest metros, rents continue to increase at double-digit rates, with July's median rent hitting almost $1,900. Realtor.com's weekly housing numbers point to continued improvement in the number of homes for sale, a move in the right direction. However, list prices remain on an upward trajectory as we traverse the summer season. Stay cool this week and keep an eye on the latest numbers at our website and Twitter feed. We'll be back next week with another video update.